With Amazon's AWS or Amazon Web Services reporting a relatively rare and significant outage today, I thought it'd be appropriate to reflect on Amazon stock. Why is Amazon down so far year to date 2025? Along with the question of, is Amazon stock on sale? So we're going to cover those two questions and more in this video. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. You're watching Unrivaled Investing. Now, if you don't have the time to watch this full video, you can go to Flash. I'm the co-founder of Flash. See the link below, where we are leveraging AI, the most powerful models that are currently available to users, to analyze stocks. And this is the take on Amazon, where it thinks it can go over the next 5 years. I generally think of AI at this current point in time as a junior investment analyst. And I look at this framework and I'd say, yeah, this is actually pretty good, in terms of how AI thinks it could perform, let's say, over the next 5 years, roughly 100% upside, roughly 20% downside. That's how it's thinking. I actually have a little bit more of an optimistic take on Amazon, which I'll walk you through this video, but it's going to require a little bit more analysis than just showing you the slide. So let's keep going. But this is, if you want to pull up any company anywhere in the world, check out Flash. It's free to pull up these company reports. And so the question of why is Amazon stock actually underwater so far year to date in 2025, that's going to be the first part of this video. I think part of the concern is the fact that Amazon is looking to spend so much on their infrastructure, their capital expenditures on their AWS business. They talk about looking to spend roughly on pace for $100 billion plus. I think just based on the most recent quarter, it's actually closer to $120 billion on an annualized basis. So that does cause investors to go, wait a second. I thought, just a year or two ago, it was about getting back to significant free cash flow. And, they went from cash burn to a lot of free cash flow. And now that free cash flow is melting away as they're reinvesting. I personally think management, Andy Jassy, Jeff Bezos, thinking about that alignment, this management team knows how to invest for the long term, and they're making bets that generally make sense to me. So if management's saying, hey, we're going to be investing $100 billion this year, generally they know what a good return on investment capital looks like. So I think shareholders should actually applaud the news that they're going to be investing more and more. But I think what actually gives investors pause, one of the things, is also the fact that their market share in their core business, AWS, their web services, actually may have slipped this past year. There have been signs that they have been losing market share to faster growers like Microsoft and Google, which do show signs of increasing. And you could just compare by growth rates, where Amazon is growing, yes, significantly. AWS is still growing at a good clip, but relative to its competitors, it's definitely growing slower. And so this does suggest that there are these, players that are taking market share. And Microsoft and Google, shouldn't be ignored, in my opinion. I think another key aspect of why Amazon stock has come under pressure year to date is just the reflection that we are in a AI revolution. This is a very exciting, point in history. Microsoft has their alignment with OpenAI. Google has Gemini. What does Amazon have? Now, they do have some investments with Anthropic. So does Google. Google also owns a stake in Anthropic. So it's really unclear. Wait a second. How come Amazon isn't really pushing the AI race in the same way that Microsoft and Google have this sort of horse that can drive their cloud infrastructure? And so that I think is a common pushback, saying Amazon may have missed this. I mean, they do, once again, have a minority ownership. Maybe someday that turns into an all-out acquisition, but so far that's not the case. I think another reason why Amazon stock has come under pressure is just the concerns of, will governments around the world sort of go against big tech? And we've seen that initiatives across various different angles, one of which is the Federal Trade Commission, securing a historic multi-billion-dollar settlement against Amazon relating to their, Prime subscriptions and making it difficult to cancel. Personally, that hasn't been my experience. And I think that does reflect that if the government wants to say, hey, we just don't like you, or we want you to pay me a few $1 billion, governments around the world will figure out a way to do that. They'll just make it harder to operate. And I think we are going from a cyclical perspective of going, hey, we should celebrate to these companies, which I personally believe in. This is a channel that's like, I want more billionaires, not fewer. I'm all for it. But I also recognize that we have maybe this push from a government perspective to say, maybe I don't like your political angle because Jeff Bezos also owns the Washington Post. And you know what? I'm gonna hurt you where I can, and we're gonna do it through trade practices. So you can have, that perspective. Even simpler answer for why Amazon may have come under pressure so far year to date is just the fact that Jeff Bezos's first wife has been significantly cutting her stake in Amazon, the shares she got in the divorce settlement, where she supposedly cut her stake down something like 40% this past year. A huge cut. And now the stake is only worth around $13 billion is my understanding. So that it might just be as simple as that. You might have all these other concerns, like how come, you're not a front runner in the AI race? Maybe your cash flow is getting eaten up by these capital expenditures. Maybe it's the government squeezing the business. Maybe it's just as simple as that there was a lot of supply in this past year, as, one of the, indirect founders, you could think, the wife of the founder, Jeff Bezos, is significantly trimming her shares. So let's go back to the core other question. So we've sort of covered an overview of why Amazon stock has been under pressure. I don't think it's really as much fundamentally driven, because we're going to talk about those fundamentals in just a second. So let's review, is Amazon stock on sale? And so when you think about Amazon, it is important to recognize that Amazon has so many different business lines. You have their online stores, you have their physical stores like Whole Foods, you have third-party services like fulfillment for third-party merchants, you have advertising revenue, subscription services like Prime, you have AWS, you have other is becoming increasingly relevant as they consider things like healthcare. And so when you're thinking about this, each of these business lines also have very different profit attributes, and that's what makes it harder to value something like Amazon. For example, their physical stores, it's really hard to get some sort of edge where you're saying, yeah, this should be a 10% plus operating margin business. It probably won't be. A lot of grocery stores, you're probably talking about 3-5% at most. You're not talking about a 20% operating margin. You're talking about a 30% gross margin basis, for these types of businesses. For advertising, however, advertising is a beautiful business for Amazon, and that, based on looking at how other companies, operate, that is likely a very high margin driver for this business. You're talking about, probably 40% plus operating margins for something like advertising, maybe even more. And so that, could significantly influence how you think about this business. So there's a lot of different line items, subscription services. You might think, well, wait a second, that requires the logistics to get the truck, to deliver the package. And the service just keeps getting better in my experience, where it's gone from next day to same day. Incredibly impressive. But the subscription, it's like, okay, well, is this a profit driver for them? Or is this just sort of going to profit neutral? Or, if you're leveraging, video content, will that actually result in better profitability? So there's a lot of moving pieces here. I think the way to think about it actually is to break it down into the individual segments. And that's arguably what management focuses on, because they don't show you the profit per business line. They show you the different segments. And you can see North America is actually doing quite well. Most recent quarter, around 11% revenue growth and near record operating margins of around 7%. This is one that's really been a wake-up call for me personally, because previously it was tough for me to really underwrite that their core North American operations, including online, physical, fulfillment services, third party, all that's baked into North America. I really hadn't seen signs that this could be, let's say, a much higher operating margin business. I mean, you zoom back far enough and there were articles talking about, Amazon blowing up. So this is, I think, proof positive that this business, their core retail business, can be very lucrative. And you can see that it's doing about $20 billion in operating profit per quarter. But most critical is this idea that maybe this could be around 7, 8, 10, maybe even more operating margin, especially as their advertising business scales. So I think this is something to think about. And this is a very clear positive development, seeing this margin going from 5% to 7% in the most recent quarter. And that, frankly, did impact how I think about valuing Amazon. Next up is international. International, frankly, hasn't been great, in my opinion, growing only around the same growth rate as North America, which does reflect, in my opinion, that they're likely losing market share to they're likely losing market share to the local players. And if that's happening, do you really want to keep putting more capital after this? So that creates a whole separate argument of maybe Amazon should, think about selling their operations to international players. People will disagree about that, but it just makes me wonder, after so many years in the international arena, to only be posting growth rates that are comparable to North America, and they're not anywhere near the same sort of profitability. It just makes me wonder, thinking about it. You could say that, hey, they're just going to keep pushing on delivering. And you could even argue that they have some sort of advantage in doing it because, hey, why don't they take the profits from their North American segment and they could just subsidize international growth, and they don't care about running those profitably if they want. They can possibly take market share even faster. That would be one theory. But so far, I would say international is probably losing market share relative to local players that are growing much faster. One of my top positions is a international e-commerce player, actually a couple of them. And they're just growing much faster. They oftentimes do see Amazon as competitors, but it's just not, they don't have the local on the ground experience services offerings that is winning market share. And you're also seeing it, the sort of suboptimal margins. Amazon Web Services, or AWS, this is doing very well, possibly losing market share, growing only around 17% when the market itself might be growing closer to 20% plus. I've also been impressed with how their profitability has improved so significantly, from 30% margins to 37%. So this is, it makes me wonder how sustainable this is, how much of this is based on just sort of accounting for how long their servers will last, those sort of questions. But overall, this is their most lucrative segment. It's still growing well above their other segments. So clearly, AWS is a lot of value for when you're thinking about Amazon. But is Amazon actually undervalued? And before we dig into that, specific, showing you my frameworks, first of all, none of this is financial advice. Also, super quick plug. Last week, Joe R. shared, Daniel, thank you for all your insight. I've made almost $1 million following along with your investing journey. This follows San C, who wrote, I initially signed up for the light subscription to test the waters. Since then, your analysis and insights have provided so much amazing value. I've regretted not going all in from the beginning. He's talking about the premium subscription. We have a new community with the Unrivaled Investing premium subscription. Prices are going to be going up later this month, so now is the time to lock it in. And so when I think about Amazon, I think it is important to reflect this is a business. And if you haven't read all of Jeff Bezos's letters, and he has this wonderful book over my shoulder, Invent and Wander, which is a collection of his annual letters and speeches. It's very, it's thought-provoking and makes you think they deserve to win, and there's a reason why they won. And it's also helpful as you think about, other businesses that you may want to invest in. So I think it's important to say this is a company that's going to keep on making bets where they see huge opportunities, and they're just going to try, and they're going to fail a lot, but they're going to try to, unlock huge new opportunities. One of which I think you could argue is getting into the healthcare space, where you can see, they're moving into not only providing healthcare services, and they're talking about pay-per-visit healthcare for kids 2 to 11. This is using the Amazon One medical plan, but they're also looking to get, into the pharmacy space. Unclear whether or not this has the potential or will disrupt what is otherwise a huge market. U.S. healthcare as a percentage of GDP is something like 20%. It's 1/5 of the U.S. economy. So that is just huge. And so no wonder Amazon's thinking about, hey, how can we break this? How can we disrupt this? Historically, Jeff Bezos has sort of a saying, at least it's attributed to him, of, your margin is my opportunity. Maybe they'll figure that out. And with AI, which Jeff Bezos literally has been talking about for the better part of this past decade, I think there's a good chance they do figure out a way to bring healthcare costs dramatically lower in the years ahead. And maybe that could be a growth driver for Amazon in the years to come. Another key aspect for investors to think about is their advertising business just is doing very well and arguably has years and years of growth ahead of it, especially as, you're thinking about Prime getting more and more content. Maybe it's getting live sports. Maybe it's getting more movies. Maybe it's using AI to generate content. It's going to become even cheaper to create more movies. And so you're going to say, hey, this custom catalog built just for me that Amazon knows based on my viewing and my shopping, here it is. We just made this for you. We know you just bought, cat food. Maybe you're going to be interested in these videos. Who knows? Maybe you even create that content. So I think, the runway for their advertising business. This is one of their faster growers, continues to post, strong numbers. Another prospect is that, they reboot Alexa. This is definitely a lead that I'd argue they've given up, and maybe there's some sort of push in robotics. Who knows how that plays out? So as we think about the different segments, this is hypothetical. Of course, stock price can go higher or lower, but I want to build into I want to think about the different pieces. And so we have North America. North America is arguably worth somewhere between 1/3 to 100% of the current market cap. Thinking about how we look at these different pieces. The big change with this video is thinking about how North American margins could be long term. And just based on how much they've been able to improve this past year, I think it is important to reset my expectations, which were previously a little bit lower, to closer to 8 to 12% over time. Currently, it's around 7%. Most recent quarter was around 7.5%. So I do think that that trajectory might suggest that their margins long term might be around 10%. Give or take. So then the question is, well, what's the growth rate in the years ahead? This is, they've become so big that they are tied to the U.S. economy. So if there is a bit of a recession, I would expect lower growth rates, maybe even a contraction. However, it is a very valuable business and a lot of consumers love it. So I think, a fair market value, I think, seems very reasonable. The market's currently trading around 25 times, assuming a similar multiple for Amazon's North America segment seems appropriate as well. AWS, I do factor in international in the summary sheet, which you'll see in just a second, but it's so small relative to North America and AWS. We'll just skip it for now. But AWS, arguably worth more than half of the current market cap and possibly worth over 100% of the current market cap. And the question is, well, what's the long-term margins? Because margins have improved a lot significantly, have improved significantly this past year from around 30 to 36, 37%. So the question is this going to stay at that rate? Are they not accounting for their server depreciation at an appropriate rate, because of all this CapEx that they're having to do? And, I'm thinking that roughly it continues growing at a teens rate. Maybe I'm being a little too conservative here. I'm assuming a slightly higher valuation for AWS 5 years out. So putting all the pieces together, based on where the stock price trades today, you're around $2.3 trillion market cap. Think about their North American operations, think about AWS, think about international. International, once again, the smallest piece of the three core segments. And you're effectively looking at, once again, hypothetical stock prices can, you can have macro events that dramatically, impact how things happen. Sentiment can change. But looking at this hypothetical framework, I'm roughly saying that over the next 5 years, it wouldn't surprise me in a low case that it actually compounds around 1%. You factor in a couple percent for the cash flow that goes to shareholders each year, as they're expected to keep generating positive free cash flow. And then in a more of a high case, you might even compound closer to 20% plus over the next 5 years, closer to, 100, 200% type of upside. So I actually am of the mind that as I look at Amazon now, that it is arguably undervalued. And I do like that asymmetry of over the next 5 years, maybe if it's, slightly better than break even, possibly, and maybe over, the upside, maybe it's closer to 100, 200%. Those are the types of bets I like to make. And it's no surprise to see, major investors like Bill Ackman say, maybe I want to own Amazon because they have these big funds and they're trying to find setups like this. Now, personally, as a smaller investor, I can find, smaller than something like a Bill Ackman, I can find plays that are, let's say, $3 billion market caps and have much faster growth and better risk rewards. And literally just earlier today, I was calling out to my subscribers at Unrivaled Investing, a company where the framework's closer to, 40, 50, 60% upside on the low case, using what I think are conservative and reasonable assumptions, and closer to 300% upside or maybe more on the high. So anywho, I think every investor needs to figure out what they want to own, what are the risks that they're comfortable with. But for those investors that want to stick to the mega caps, the $2 trillion types of names, wouldn't surprise me if Amazon actually does quite well or very reasonably over the next 5 years, even though so far 2025, it's been struggling and it's been slightly underwater. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.